Well, as earnings season starts to wind down, investors are getting a more positive picture of the health of American corporations than analysts had initially predicted. 3/4 of S&P 500 companies that have reported as of Friday have beaten estimates, according to FactSet, with the index setting 3 record closes last week, the newest highs since July, and the 3 major indexes are all hitting record highs yet again today. Joining us is Danielle Shay. She is the Director of Options at Simpler Trading, and Quincy Crosby. She's the Chief Market Strategist at Prudential. And Quincy, let me start with you because we're looking at record highs again today. What do you think is really driving the optimism right now?
I think there's a confluence of events. I mean, you just look last week, just for example, besides the trade truce, or it looks like a viable truce, regardless of what is inside phase one, you had the employment reports, not just a surprise to the upside, but you had 2 months of revisions upward. That's very positive because 68% of the economy is predicated on the consumer. And there were worries that perhaps we would have a much weaker number because of the General Motors strike. But the fact is the number was good, but the revisions helped bolster that report, that the consumer remains in good shape. And that also helped weaken the idea that a recession is in the offing, because if the market believes a recession is coming, we will see a 20 to 30% sell-off. So that helped. In addition, the Federal Reserve. That was very important. One word, significant, that they would not raise rates unless there was a significant boost in inflation, telling us that the Fed will probably be on hold for some time. And that also is helpful for the consumer as well, and also for the market.
Danielle, let me bring you into the conversation. I mean, Quincy rightly points out some of the data points that we got, especially that jobs report that pointed to the strength in the economy. But we also got other data last week, like business investment, that was much weaker than expected. I mean, how do you sort of connect the dots on that front, and what does that tell you about the health of the economy right now?
Well, we've known for some time that the economy has been weakening slightly, particularly because of the trade war. But what I feel at this point is that those fears were a little bit overblown over the course of the last 3 months. We've seen a lot of those high momentum stocks trading lower, such as cybersecurity, IPOs. But the test was really in earnings. And we know there are some companies that are trade related, like Caterpillar, that traded lower and didn't do as well on their earnings reports. But for the most part, the S&P is strong, earnings are strong, and so I think that we know there's a data point that the economy is slowing slightly, but we're still very strong.
Quincy, I see you're nodding your head here, but isn't there an argument to also be made that the bar was pretty low going into earnings, and so it wasn't that hard to beat expectations? How much do you read into that beat when you look at the overall number coming from some of these companies?
Well, absolutely. We do go into these earnings reports increasingly with the bar set lower, but the fact is the top line revenue growth for the companies that did beat was actually solid, and the guidance wasn't horrific. Going into the earnings report, you would have thought we would have horrific guidance from companies. That wasn't the case.
It's not exactly an endorsement, though, right? It wasn't horrific, but
no, but it was solid, and you're getting a sense also, just not from the U.S. You take a look at, you mentioned Germany in your last segment, the DAX. Basically looking at a global economy, despite the fact that the data releases are pretty negative, but the market was going up on the back of perhaps the global backdrop becoming more attractive, even in terms of the economic underpinning. One thing on a technical side, the market moving higher this way is forcing those shorts to cover. So I want to make it clear that a lot of this move into the market right now is short covering, and that's powerful. What you need now is for the money that's on the sideline to come into this market and take it and underpin it with some conviction.
So Danielle, let's pick up on that point. I mean, what do you think it will take for some of that money that's been on the sidelines to come back in? And at least on a personal level, what has that been for your portfolio? What are some things that you're switching up?
So for me, now that we've gotten through this strong earnings season, I mean, we typically see a bit of a pullback after a strong earnings season anyways. And I think because the market has traded higher over the course of the past couple of weeks, we're due for at least a pullback to the mean, which would be around the 50-period simple on the daily charts and the indexes. And at that point, I'm definitely going to look for the high momentum stocks, especially the FANGs. I mean, those are absolutely critical. You know, we need to see Microsoft holding on a pullback. We need to see Amazon holding up, Facebook, Google. As long as these market leading stocks can hold on a pullback, I'm going to continue getting into semiconductors. I also like housing here. And then, of course, the key tech names.
Okay, Danielle Shay and Quincy Crosby, great to have both of you on today.
Thank you.